Thank you everyone who's joined this Fox Williams webinar on the FCA's new safeguarding rules. Very glad to have you with us today. I'm delighted to be presenting today with my colleagues Chris Hill, Peter Finch, Louise Neve, and Gloria Palazzi about the new rules that the FCA is bringing in on safeguarding. These rules have had quite a long genesis. I think for quite a while, the FCA has been concerned about safeguarding in the payments space and wanted to do something about it. More recently, it consulted in the last quarter of 2024 on potential rules and then published the final rules in August this year, and they'll come into force in May next year. To kind of provide a bit of context on why the FCA is concerned about this area, there are kind of multifaceted reasons why they think that change is needed. Partly scale and the resulting risk has grown. So 10 or 15 years ago, payments were seen more as something that people would do with relatively small amounts of money. They wouldn't be, for example, receiving their pay or their student loan into a payment account. It would normally go into a bank account. And there's been a massive growth in the scale of kind of e-money holding in the UK. At the same time, there's been concern about safeguarding practices. So particularly through supervision work, but also where there have been failures, they've been found to be an average of 65% shortfalls versus amounts owed. So the FCA is very concerned about being able to return funds to customers in a failure scenario. Of course, the FSCS doesn't cover failure of a safeguarding institution. It only currently covers where a safeguarding bank fails. So there's a gap there, which means that the safeguarding regime needs to be robust. The FCA has also been doing recent work around risk management and wind down plans, and has been concerned about the robustness of the kind of modeling and stress testing that firms are doing. And so is also concerned about risk management being done appropriately. And then the final reason they kind of cited for change was around some of the case law around whether there's a trust or not around the safeguarded assets. And their solution for that was a statutory trust, which in practice has been shelved for now. But they are also, I think, concerned that the case law in this area has created some uncertainty. Hand over now to Peter, who's going to give you an overview of the proposals.
Hi, everyone. Just some housekeeping that I know Omar was very keen to start because he loves this. But we've got two things I need to tell you. First, there's a Q&A. So if you've got questions, please put them in the chat. And we will do our best to leave some time at the end to answer them. If we can't answer them right now, we will take them away and can come back to you separately. So please do fire away. And secondly, the session is being recorded, and we will be sending out a copy of the recording afterwards. So if you want to watch this again, as I'm sure you all will, it'll be hitting your inbox afterwards. So before we get into too much detail, we thought it's just worthwhile taking a step back and just working out actually kind of who's in scope. So who's caught by the new rules. On the screen, we've got a nice summary. So authorised payment institutions, all caught, unless you are solely providing PIS or AIS. All e-money institutions are caught, including small e-money institutions, and credit unions who issue e-money in the UK are also caught. 2 points of note just on the scope. The first is that small payment institutions are outside of the rules unless they choose to opt in. And secondly, there is no concept within the rules of kind of agents, distributors, program managers being a separate kind of entity. So the obligations will sit with the principal in any of those arrangements. In terms of how the rules are being implemented, as Omar touched on, given the kind of intense industry feedback, we've ended up with potentially kind of a two-pronged approach. So we've got what the FCA is calling the supplementary regime. So that comes into force 7th of May next year, and that that is kind of geared at ensuring compliance, record keeping and reporting, and kind of uplifts in all those areas. And then we have a potential, what I'm now calling kind of a post-repeal regime, which would focus more on the statutory trust model, which I know everyone had quite potential concerns around. So in terms of that post-repeal regime, the FCA has said that they won't even consider kind of consulting on that until potentially the end of 2027. And really the messaging appears to be kind of for firms to demonstrate and show compliance with the supplementary regime and kind of prove to the FCA that nothing further is required. So I think the aim is to really get everyone up to scratch to what's required, and hopefully that the kind of that will be the end of it. If the post-repeal regime is required, it will require some fairly heavy lifting in terms of the legislative framework. So we would need to repeal PSRs, EMRs, etc. So it wouldn't be a kind of a lift and drop. But either way, I think, as we mentioned, as we're going to come on to, I think that the ask for firms from the FCA is kind of meet the current standards and show us we don't need to do anything else.
So one of the real focus areas for the FCA is around books and records. It really wants to make sure firms are doing this properly, and it's essentially codifying and expanding requirements that are currently in the approach document to cover a whole range of areas within books and records, from governance, policy and procedures, internal and external reconciliations, the keeping of records and accounts, and notification requirements. There's a kind of real kind of consolidation of really explicit requirements in terms of what the FCA is expecting to see in policies and procedures. A lot of this is going to be existing or best practice or things that firms are already doing. But I think what the FCA is doing here is really laying down a marker that it's very clear about what its expectations are. They're kind of spelled out in the rules in more detail. And so when they come to supervise it, it'll be more clear what they're expecting. The other aspect of this is there's now a requirement to allocate a single director or senior member of staff of sufficient skill and authority responsibility for operational compliance with the safeguarding rules and for reporting to the board in relation to this. This obviously shows that they want to have some more kind of individual accountability potentially around this, but it does also create a slightly kind of strange development of the EMD and PSD individual regime, given that payment and money firms are outside the scope of the SMCR. So it feels a bit like they're slightly building a kind of quite bespoke regime on an ad hoc basis, when within the SMCR there's an equivalent CAS kind of prescribed responsibility. And you might kind of wonder whether this is creating a bit of uncertainty around what exactly is expected and what the standards are compared to the SMCR. Again, here on records and accounts, there is a kind of codification of requirement to make sure that you have accurate accounts and you're able to at any time distinguish between relevant funds and other funds, and also keep a track of reconciliations, which will also be important when we get to the notifications bit later. They also provide that you can rely on third parties for the purposes of creating and maintaining records, but only where no other method could reasonably be employed. And the example they give of that is where funds are applied automatically to clients' balances via an API. I think that, again, this is an area where firms should have procedures in place already, but this is probably an opportunity to go over them and make sure that they not only are there in writing, but are actually operationally robust. The FCA has now stipulated that reconciliations need to be done every day. There was an initial proposal that this would be a requirement every day, regardless of whether it was a weekend or a bank holiday. There was a lot of pushback about the reasonableness and practicality of doing that from the industry. So the FCA has kind of taken that on board and has now just said that it wants a reconciliation at least every day, excluding weekends and bank holidays. But it has also specified that it wants those reconciliations to be at the same reconciliation point at each day, or points if you're reconciling multiple times a day. And then it's also said that where firms want to use non-standard methods for reconciliation, then that will need independent auditor approval and documentation. So again, this is an area where it's worth looking again at your reconciliation process and make sure that the process for doing these is robust. Similarly, on external reconciliations, there is, again, that being set down as being once a day, and the requirements around resolving discrepancies being put into the rules. One thing that is potentially maybe challenging is that there's an expectation to align external and internal reconciliation points where possible. So if you're not doing that at the moment, then you need to consider either whether you're able to do it or whether you can document how you're going to maintain accuracy in those situations. So I think this will be an area where, as is already the case, firms will need to work very closely with their safeguarding bank to make sure that they've got the right data and are able to do the external reconciliations as required. So the notification requirements are possibly the kind of most tricky new kind of requirement in this area, probably. So essentially, there's a requirement now to notify the FCA in writing and without delay in a range of different situations. So that includes if internal records and accounts are materially inaccurate, invalid, or out of date. If the firm will be unable to or materially fails to conduct a reconciliation discrepancy cannot be remedied, or if the firm becomes aware at any time in the preceding 12 months the amount of relevant funds safeguarded was materially different from that required. The kind of challenge is that the FCA hasn't defined what it means by material in these situations, and firms will have to apply their own judgment on a case-by-case basis. Firms already do that where they're investment firms in relation to the CAS 7 rules. So there is, some precedent for how to do it, but it will be something that firms will need to think about. It could also be something that's covered under the, although I'm not holding my breath that this will happen, but it could happen, could be covered by the FRC audit standard that's being developed. So the upshot of that is that firms will need to make sure they have clear policies for the internal triggers that mean that an FCA notification is required, and also where there are incidents, have a process for documenting whether they're determined as being material or not, and so that there's a clear audit trail of that decision making. Handing over now to Louise, who's going to talk about safeguarding audits.
Thanks, Omar. An annual audit is required by all in-scope firms, and those are the firms, so the payments or e-money firms in scope who have held at any point in time during the previous reporting period, so the previous 53 weeks, more than £100,000 of relevant funds. The exemption is a proportionality kind of almost concession that was implemented post-consultation. So if a firm hits that threshold, so they've held £100,000 more of relevant funds at any point in time, they'll trigger the requirement for the annual audit. The annual audit, it can align with your annual accounting period, or it can be shorter, but it cannot exceed 53 weeks. The audit needs to be carried out by a qualified auditor, so that's an auditor that's defined under the Companies Act 2006. It can't be a compliance consultant. So naturally, there have been some questions around capacity for auditors who qualify for the purposes of this requirement. So in terms of the appointment, there is a requirement on firms to take reasonable steps to make sure that the auditor has the necessary skills, experience, resources to be able to perform the audit competently, capably. That's going to depend on the complexity of the particular firm. So if your business is relatively simple, more straightforward, well, then that will naturally have a bearing on the type of auditor who you can appoint, and possibly also on the cost of the audit. The first audit period is going to commence in line with the stated commencement date of the rules, which is the 7th of May 2026. The first audit period is going to end 53 weeks post that. Then for the first year, there's a concessionary 6-month period that has been provided to allow you to kind of provide that first audit report bedding in. After that, the audit report will be due within 4 months of the end of the audit period. The FCA has decided not to issue guidance with respect to those firms that are not in scope of the audit requirement, but have issued kind of a gentle nudge to encourage them to undertake an audit, because for assurance, good practice, it's also a tool to help manage risk. And so while out-of-scope exempt firms are not subject to any guidance by the FCA, there is a gentle nudge towards undertaking the audit. As Omar mentioned earlier, there has been some degree of concern and questioning over what needs to be reported in the audit report and the materiality standard for breaches. Forthcoming guidance from the Financial Reporting Council is expected before the rules come into force, which should help provide some clarity and a methodology which will help a consistent approach to be applied across all firms. So from a practical standpoint, what does this mean for firms? So, first off, you're going to be identifying who in the firm is going to be responsible for overseeing the audit compliance. So the responsibility, is that going to be with one particular senior manager, or is that going to be a shared responsibility? Who are the teams? Who needs to engage with who? How are they going to engage with the auditor? Who they're going to appoint? Demand is expected to outstrip supply, and therefore it's going to be a good idea to identify the auditor for your firm as soon as possible. You're going to have to check kind of capacity, work through timescales, and budget. This isn't expected to be a cheap exercise, and obviously the more complex your firm, the more expensive this process might be. There will also be a need to align your internal compliance processes and procedures to enable the auditor to access the relevant information that they need to be able to provide their report, to allow the sharing of the relevant information, data, as and when needed by the auditor. There's going to be some tech requirements, we suspect. There will also be a requirement, and this timescale should also be factored in to the timeframe for submission to the FCA, is that once the auditor has produced that audit report and they've produced that report in a form that's prescribed under the new rules, you will have an opportunity, if there are relevant breaches or any form of breaches that have been identified in that report, to be able to comment, assess, importantly, start working through what those issues might be, to correct, to remediate any issues that have arisen from the audit. The report will need to be presented to the board. The board will need to have oversight. They'll need to sign it off. This is essentially another governance tool, and also links to accountability of the board to make sure that the safeguarding systems and controls are in compliance with the relevant requirements. So that will all take time. There will be process changes, tech changes. So While we think that the first audit period seems kind of quite a way in the distance, that's going to come around pretty quickly. And so that's an important factor to bear in mind, kind of the practical processes that need to be created and embedded in the firm. So now I'm going to hand over to Gloria, who's going to take you through the reports and the returns that are going to be needed.
Thanks. So, as highlighted previously, an important part of this new regime are the reporting requirements. And a key part of this will be the monthly report, which is a new requirement for firms to submit a monthly regulatory return to the FCA relating to their safeguarding arrangements. The form has already been piloted. It's available in Sub 16 Annex 29B. It is broadly similar to the version the FCA consulted on last year. There are a few variations for clarity, but there have not been any new questions added. The return does remain monthly, as it was in the version originally consulted on, even though some responses to the consultation questioned whether it should be done less frequently, particularly for smaller firms. However, the FCA decided that it was proportionate for smaller firms to also submit the return monthly, and for smaller firms to also submit effectively the same return as larger firms. The return must be submitted to the FCA within 15 business days of the end of each calendar month, and it covers a wide range of data points, including the methods used to safeguard relevant funds, the number of clients for whom the funds are safeguarded, the use of any non-standard reconciliation methods, and a detailed breakdown of balances, accounts, and assets that the firm holds. The return requires firms to confirm that any notifiable breaches in the safeguarding requirements have been notified to the FCA, and any errors in it must subsequently be reported, be notified back to the FCA. In terms of implications of this monthly return, it may be possible that payment firms will need to make adjustments to their internal processes, systems, and controls to ensure that they can meet the new reporting requirements on an ongoing basis. So not just for the initial return, but as this will be a monthly obligation going forwards as well. Firms should ensure that the quality of the data collected and used to populate the return is sufficient for the FCA requirements. There should be robust governance processes established to ensure that the senior manager responsible for the safeguarding has sufficient oversight of the final return submitted to the FCA. And in terms of cost, the FCA estimates that the return will take one compliance professional about 5.25 hours to complete monthly, which it believes will result in an annual increased cost of £3,060 for small firms, £4,000 total per year to larger firms.
Thanks, Gloria. So I'm going to talk a bit about the focus on strengthening and safeguarding practices. There's a theme running through this, as Omar said earlier on. A lot of this is about codifying and mandating best practice, and just making sure that, putting the conditions in place to make sure that things are done properly. So firstly, I'm going to look at third-party controls. There is a new requirement, an explicit requirement to exercise due skill and care and diligence, essentially doing good due diligence when appointing third parties in the particular for the particular activities of holding relevant funds, so banks, custodians of assets, and insurers or guarantors. That diligence needs to concentrate on a number of factors, including market reputation, financial strength, both in terms of capital and credit worthiness, and I think particularly for the investments side of things, it is the previous risk profile of the custodian to the extent that that information is available. This is not a once and done process. It's very much something that is meant to be an ongoing due diligence review. It talks about periodic review. There's sort of one instance, I think, in terms of the letters, which I'll come on to, where it explicitly says at least annually. I think at least annually is probably a good idea, but it's sort of fact dependent. What's your sort of sniff test as to how recently you've done this, according to what market conditions or changes in your business may be. There is an express need to at least consider diversification. When the post-repeal rules were consulted on, there was initially a requirement to have diversification, which a lot of people pushed back on, partly because of sort of concerns over supply of relevant services and whether it was practical for people to be able to have multiple safeguarding banks at the same time. Where it's ended up at in the supplementary regime is around at least having to consider the diversification and having to record that you've done so. Ensuring identifiability where the funds aren't in designated accounts. That goes in particular to the acknowledgement letters, which are now much more prescribed than they used to be. There used to be kind of relatively vague description of what those would look like. Now, there's a sort of very formulaic template, like you see in other areas of regulation. In order for the letter to count, it has to meet exactly that template, and you're only allowed to amend a couple of different bits of it. If you amend more than that, then it no longer meets the requirement. And those have to be, as I said, reviewed at least annually. You have to have arrangements in place with the third-party providers, again, banks, custodians, insurers, to make sure that the funds get allocated to individual customers promptly, should they be required. And the big factor around all of this, and the theme that runs through this whole section, is keeping records of your decision-making process. Why is that? It's because the FCA wants to make sure that these considerations are actually occurring, that the discussions and the diligence is occurring. The best way to do that is to make sure that someone has to document it. So looking at the other two aspects more specifically, so investment, the new rules confirm that firms can continue to invest relevant funds into exactly the same range of secure liquid assets that you had before. There's a very low risk tolerance for making that any broader than it was before. That may be reviewed over time. There are slightly tighter restrictions on which assets can be used. There used to be a kind of 1.6% limit on the risk capital charge. Now it's 0%. There is still the mechanism in there to be able to apply, for a firm to apply to the FCA to say, actually, can we use this asset instead? Where a firm does that, it'll have to justify the operational risks and the liquidity strategy around it. And again, you've got this due diligence theme running through it, that as a firm you have to consider these general principles and conditions when you are making your selection, and document it. Though those general principles are all around the spread of investments that you've got. It talks about having an appropriate liquidity strategy, an appropriate credit risk policy, and dealing with FS risk across your investment base as well. Again, you've got to document the decisions, you've got to review them. It is not a once and done thing. Moving on to the insurance or guarantees method, that is still a permitted method. As we understand it, there's not that many firms that use this method on a large scale. The new rules tighten up the insurance method. It's a lot less vague than it used to be. And in doing so, I think our hope is that it will facilitate people using this method a bit more, which can obviously free up some liquidity for the firm. So a number of quite strict conditions. Firstly, the policies or guarantees, they have to pay out promptly. Fine, no particular surprise there. If you're going to use one of these insurance policies, you have to notify the FCA at least 2 months in advance. You have to also notify of any changes to it. When you are making one of those notifications, you have to put quite a lot of, it's very prescribed, you have to put quite a lot of detail in about how you've come to the decision, exactly what the terms are. And again, it's sort of documenting that decision so that you can justify it if the FCA comes knocking. On the policy conditions themselves, it's quite strict. It's saying that the policy can have no conditions in it that prevent payout in any condition other than insolvency certification. And that process of certifying the insolvency says that it can't be more onerous than is practically necessary. Not entirely clear what that means, but it's clearly limiting an insurer's ability to try and argue its way out of having to pay out in the event of an insolvency. Interesting condition around there being no ability for the insurer to be able to cancel the policy. It says non-renewal later on is actually about cancellation of the policy except for non-payment, and even then they have to give a full 3 months notice. This is to prevent a cliff edge scenario where a firm has been using the insurance method, loses its insurance policy, and suddenly has nothing else in place to back up the money that's issued. Equally, if a firm decides that it's not going to renew its policy, then it has to have contingency plans in place at least 3 months in advance to make sure that it's got its ducks in a row to be able to switch to segregation as and when that policy actually lapses. So there's quite a lot going on there. The overall theme, as I say, is tighter control, stronger, more detailed consideration, ongoing consideration, and that is largely facilitated or strongly encouraged, I would say, but by the requirement to document all of those decisions, not just at the beginning, but on an ongoing basis. What does it mean for firms? So firstly, go about the business of refreshing that third-party due diligence, make sure that you've got the systems in place and are setting the time aside to monitor those third parties, their financial strength, and particularly operational resilience. Looking at a concentration risk because of that requirement to at least consider diversification. For instance, have you got all of your eggs in one basket? Have you grown enough that actually it's sensible to have another provider in place? And thirdly, very much the process of getting the required audit engagement letters in place along the lines of this new template. Okay, that's that. I'll hand over to Peter to talk about the ever difficult question of when safeguarding begins and ends.
Thanks, Chris. Yeah, so I've been tasked with this topic, which, as many of you on the call know, is a fun one and a point of contention for, well, contention discussion perhaps is a better word for many in the industry. So kind of just taking a step back, we know that PSRs and EMRs are kind of obligated to safeguard relevant funds under the relevant regulatory framework. That's clear. We then have some kind of pretty high level guidance, I would say, in the approach document around when that obligation starts. And that guidance says that the obligation starts as soon as your institution receives the funds, and that this occurs as soon as a firm has an entitlement to them. Again, kind of on its face, all pretty clear. The difficulty being, as we all know, that within this space, the typical payment flow involves a huge number of different entities, intermediaries, from acquirers, program managers, agents, etc. And so in real life, the ability to apply that pretty high level definition to those scenarios becomes a lot trickier. And certainly what we have seen is that firms will take quite differing views around those models and when their obligation starts. And often those views are, I would say, kind of beneficial to the firm involved because they've set up their systems in a particular way, or it kind of reduces their obligations accordingly. So we do see divergence. And to be honest, most of those views are defensible given the high level nature of the guidance. So with that in mind, there was, I think, some discussions in the consultations around kind of further information kind of guidance from the FCA on this. Where we've ended up, though, is not really kind of necessarily tackling the issues. So effectively, what we have is some changes to the approach document, which I suppose more kind of principally constitute a tidying up exercise to really ensure that the supplementary regime and the approach document don't conflict. So we do have some additional guidance from the FCA on kind of when safeguarding obligations are triggered, but they're principally around kind of quite distinct scenarios. So foreign exchange transactions, situations where kind of payments are made before the funds are received. And arguably it doesn't deal with some of the more trickier and nuanced situations that kind of that we often are having discussions with our clients with, and where they're running into issues. So kind of in summary, not much has changed in this space. I suppose the thing that we might want to keep in mind, though, is more detail in this area beneficial for firms, and kind of how much do firms want to push the FCA on this, because kind of that next level of prescription might leave firms little wriggle room to argue the positions they've adopted, and may kind of lead to fairly significant operational changes. So I think for now it's just one to keep an eye on. We know the FCA is kind of open to suggestions around this, but again, it might just be worthwhile firms thinking through kind of actually what is a good outcome here, because it may lead to a situation that's not necessarily beneficial.
One of the concerns that was raised by respondents in respect of the proposed new rules was around equality considerations. Particularly, there was a concern that smaller payment firms, particularly those serving diaspora communities or led with people with protected characteristics, so that might be more disproportionately affected by these proposals. The FCA lands in a slightly strange place, because it concludes that the rules do not materially affect any group with protected characteristics, but then it does acknowledge that the rules will impact smaller payments firms and those groups that I just listed. So how it squares that circle, I'm not quite sure. But I think that it's probably, and it also kind of argues that the rules will promote competition by creating a level playing field, while some I think were concerned that it would advantage bigger players. So got comfortable from an Equality Act and kind of competition also point of view.
This is the quote from Matthew Long at the FCA. We'll be watching closely to see if firms seize the opportunity and make effective improvements that their customers rightly deserve. This will help us to determine whether any further tightening of rules is necessary. So this is quite a strong message that we've heard through different channels. And it's essentially a sort of behave in class, and we won't have to talk about detention. So it comes, I think, largely off the back of the pushback that firms gave in the consultation to the post-repeal or end state rules, as they were called at the time. And it's the idea that the supplementary regime introduces enough about tightening the rules and mandating best practice, that if we get that in place and firms are complying with those rules effectively in a way that frankly is the spirit of the original rules, then actually everyone's happy, customers are being adequately protected, and they won't need to do anything else. So very much a sort of warning message to the industry, I think. So just to recap, the key areas we think that firms should be addressing. First, you've got the daily safeguarding reconciliations. That's quite a big step up, but fortunately excluding the bank weekend, the weekends and public holidays. We've got the resolution packs being prepared and maintained. The annual safeguarding audits with the carve out that you don't need them if you're holding under 100 grand. Monthly safeguarding returns, the much tighter rules around third-party due diligence and the recording of those decisions. the alignment of the internal books and records to the new FCA rulebook definitions, and then staff training to make all this happen in practice across operational teams. Questions. We've had some interesting questions in. Go to one we've had first about the audit process. So Omar, I'm going to point this at you. In respect to the audit process, the new rules come in May 2026. So if your financial year end occurs in June 2026, the deadline for completing the audit would be December 2026, but the audit period, would this be 1 month or the prior 12 months when the rules were not fully in effect? Omar, over to you.
Okay, so the way the rules work is that the period covered by an auditor's safeguarding report must end not more than 53 weeks after, amongst other dates, the date the relevant institution first becomes subject to the rules. So that will be the 7th of May for most institutions, unless you fall into an exemption and then fall out of it. You will need to the report will need to end not later than 53 weeks after that. What I think that means in practice, given that I don't think people are going to change their financial reporting periods to align, or I don't think that would be optimal to align with the safeguarding rules, is that potentially I think you could have some of the audit cover a period prior to the rules actually coming into force. I guess there's then a question about whether the auditor would actually audit that period or not, or how that would work. I think that would be quite tricky. I think there are going to be discussions between the FCA and the FRC and some of the industry groups as well about auditing more generally, and also about the timing. So it is, I think, a difficult one based on the way the rules seem to be drafted at the moment.
Thank you. So we've had another question, which I'll take, which is what's the panel's view on the appropriateness of the insurance option and how the new rules could change the use and importance of existing insurance solutions? It's a really interesting question. So the intel we had probably about 6 months ago now, I think, was that 95% of PSPs and EMIs were using not the insurance option, but the segregation option. And the reasons quoted for that were around a lack of availability of insurance products that would fit the bill, and expense as well, and sort of a couple of other operational bits and pieces. I know a handful of insurers have been working quite hard, or insurance brokers and insurers have been working quite hard with the FCA to come up with policies that address the new rules, not necessarily to kind of have those policies blessed, but not to get an objection, I suppose, from the FCA saying you can't use that. The pricing, as I understand it, is probably a bit better now than what it used to be. We understand that to the extent that people use insurance at the moment, it tends to be for top up. So it tends to be for that they'll be segregating sort of 80–90%, and they'll have an insurance policy in place for any excess up to the full 100. Personally, I think the bits and pieces around the conditions of the insurance policy, so insurer can't cancel, the only trigger is payout. On payout is insolvency, and that in itself can't be an onerous process, means that if the insurers are willing to play ball, and I understand from a couple of brokers that there's a lot of demand, a lot of from the industry, but people asking a lot of questions about this because it frees up liquidity. If they can get to the right policies, I think it will actually become a much more viable option. Even if it's not used 100%, I think it's more likely that we'll see a lot more PSPs and EMIs using it. So hopefully that answers that question. Next question we had was around are banks in scope for this or not? Peter, that was your section.
Yeah, thanks. So no, they're not. But I suppose the thing to know is that they've got their own set of obligations and rules around kind of protecting a client funds, so that kind of not strictly, but there is protections in place which they would need to adhere to and kind of comply with.
Yeah.
And I suppose just while we're on me, there's another question come in around the impact of firms who are preparing their applications currently. Kind of, so what would the impact of these rules be? I think the answer to that is you would need to show that you're going to be able to comply with them from the point of authorization. So you would need to address the new kind of obligations within your application and show that from the point that you are authorized that you're willing and ready to meet those.
Thank you. And then next question we had about the auditing, which I thought was quite interesting, is demand for auditors going to outstrip supply? And if so, what provisions have the FCA made to allow for this, given they've restricted the supply by the form of the new?
I can cover that. So I think that the allowance they have made is to give people 6 months from for the first audit period to file the audit. That's basically the allowance that they've made. And to I mean, they did. I think in the previous set of the rules there was the timing periods for the audits was a bit more prescribed. So I think they've made that a bit more flexible. But it is I think quite possible that there could be a major problem with supply of auditors. Although I think that there will also be auditors probably entering the market who aren't in the market currently. So some of the more like mid-sized, smaller auditors perhaps. So we'll see how that develops. But I think that is foreseeable that there could be an issue on that. And to be fair, the FCA has been warned about this multiple times by the industry. So I think that if that happens, then the FCA will need to take a reasonable approach to working out a solution.
And then we've got a question about, I think, a sort of program manager type relationship. So where a company operates under an EMI licensed provider, is it the EMI provider, not the company, that's ultimately responsible for complying with the FCA safeguarding rules, and what safeguarding obligations are on the company? So I interpret that as being you've got a program manager sort of relationship where you've got the regulated, the licensed EMI, and then you've got, say, an unregulated fintech borrowing their license under some kind of bin sponsorship arrangement. So the answer to the question would be yes, it is the EMI provider, not the company, that's ultimately responsible. What I would expect to see, though, is that in those sort of bin sponsorship arrangements, that whatever the contractual arrangement is between the EMI and the agent distributor, because the safeguarding rules are being tightened up for the EMI, I'd expect to see a bunch of those contractual obligations, operational bits and pieces being tightened up as well, particularly around things like the safeguarding returns and the daily reconciliations. They'll want to see a much more regular flow of information, I would think, so that they can comply with their own obligations downstream. Right, I think at 4 minutes to 1, I can't see any more questions. So I think we can probably call it a day. So hope that's been useful. Thank you, everyone, for joining us today. And if you've got any further questions, then please do get in touch. Thanks very much.